Hey there, folks. The Enzo Di Costanzo podcast. And today we are going to do the first Excel for the plant assets, equipment, property, intangibles, depreciation chapter, or the material, really the material that we're working on. So we're doing without a camera today, if you guys don't mind. So let's get right to the Excel. Okay. Okay. So you should have this posted. See what it says plant assets? You should have that posted on Blackboard, and you should be able to download this template to your Excel, copy and paste it to your template that you're working on. So how the cost principle applies to plant assets, the depreciation concept, methods of depreciation, procedures for revising depreciation, revenue and capital expenditures, distinguishing between them and the accounting entries. And again, I mean, look, I can only teach from what my experiences are. Okay, my experiences are very heavy with accounting, regardless of what you're really special. If you're specializing in corporate finance, if you're specializing in macroeconomics, if you're specializing in microeconomics, which is studying specific companies, regardless of what you're doing, accounting is going to be a part of it. And I just wanted to give you a little bit of a taste of what that looks like: depletion of natural resources, basic issues related to accounting for intangibles. Indicate how plant assets, natural resources, and intangible assets are reported. Again, from my Queens College days, which are not that long ago, I spent a whole summer studying intellectual property and that type of thing, and certainly corporate law, contracts, and the intangible asset part of it was the legal aspect of that is it's very deep. There's a lot to it, and you're going to determine the cost of plant assets. You're going to do things like that, and actually make these a little bigger for us as we're going along here. And actually, what I can do, since I'm back in the PC, environments, I can just toggle between those two now. Depletion, accounting for intangibles, research and development costs. And again, it always goes back to the statement presentation, and it always goes. It'll always go back to that. Plant assets are resources that have three characteristics. They have a size, definite size and a shape, like a store or a table. They're used in the operation of a business. You walk into McDonald's, right? You sit at the table, you eat a hamburger, and the idea, and though there are folks who are challenging this very Western idea of you're not supposed to take it with you. There are individuals in Brooklyn and different places who plan to walk out with the cash register drawer or something like it, right? So it's but not intended for you to do that, obviously. I remember when I was working my way, the beginning of college, I worked. My last 3 years at NJT, I didn't work, but the first two I did. And I was a nighttime boiler mechanic, if you could believe it. And I learned a hell of a lot about HVAC and things of that nature. Plant, property, equipment, or fixed assets. Number one, when you own a house, right? You never wait for the coldest day of the winter when you need the heat on and your pipes are frozen, and you turn on the boiler and you have not just hot water but steam hitting maybe frozen water in the pipes. That's the surest way to crack the pipes. That's the surest way to have an explosion. Okay, and over time that's going to happen. I mean, there's really nothing because they're not going to. And again, we don't get that cold in the Northeast. The Boston to Washington D.C. area, we don't get, certainly as you go down further south, you don't get cold hardly at all. But and we're not Minnesota, we're not Montana and Idaho and places like that, or Maine that are way up there and get very cold. But that there's a good lesson in maintaining the heating. If you use a steam system, we had a chance to convert over to the heated air version of stuff. But then you're turning on your air handler, and that makes a lot of noise. So I wanted to avoid that as best. And I saw the energy bills in the summers when we ran the air condition. We have central air with the ductwork and all that stuff. And it's a bigger bill. You're running a big system, even if it's just a couple room home, which is we have about a 10-room house. But even if it's something like that. So anyhow, assets are expected to provide services to the company for a number of years, but the land is never going to be depreciated. You want to determine the cost of plant assets. You want to apply the cost principle. So all expenditures are necessary to acquire the asset and make it ready for the intended use. Companies often use land as a building site, and there's several costs that are involved in acquiring land. cash purchase price, closing costs, title, attorney's fees, real estate brokers' commissions, all that kind of thing. Yeah, I mean, just for the hell of it, you guys, I'll put it on for a couple, just to know, so you guys know it's me. But the cash purchase price, so it's not so when you record now. Again, this matters more for corporations than for an individual. But closing costs, attorney's fees, commissions, if there's accrued taxes or the liens that the purchaser are assumed by the purchaser, all that stuff needs to be recorded. And when if it's a corporation, these things are very important. When it's an individual, I'm not saying it's not important, but it's not as important. Okay, so here's the first one. A manufacturing company is gonna acquire real estate. The cash cost is 100,000. You're gonna spend 7,500 to remove some kind of structure. And my kind of horrible neighbors, the neighborhoods change. I'll say it like this: the neighborhoods changed a bunch over the years, for better or worse, right? Uh, have They threw up some housing, I guess I'd call it. Really, it's a bar. They put a bar in the backyard, and on cold, rainy nights in the summers, they rather enjoy being back there, I suppose. And if a new person shows up to buy that house, they might say, "Hey, who needs this?" Type of thing, and might do what I wish would have happened to just take it down, right? That kind of a thing. Okay. So anyway, you buy property and there might be some kind of a structure up there. Now, these costs, I mentioned this in the live class. These costs are from long ago, and you know, you're not buying property for 100,000 in 2023. Maybe in 1988 you could have, or something like that, but certainly not now. So these prices are probably from the 80s. Okay, and this accounting book's been out there a while. So what we're doing is, and you have to keep the arrows in mind here. The pluses are you spending, which might be a little counterintuitive, right? That 100,000 is being spent, the 7,500 is being spent. The 1,500 comes to you because you're selling copper wiring, you're selling maybe some fiber optics, you're selling whatever salvageable materials you can from that structure, and you're clawing your way back a little bit from 7,500 down to about 6,000. Okay. There's an attorney fee, right? We wish for $1,000, and I'm sure Trump does too. We wish for $1,000 attorney fees. we don't have that, and a broker's fee. Again, the neighbors are selling the house, and there's been a steady stream of folks walking over there. And I'm trying to figure out who my new neighbors are going to be, for better or worse. Most likely worse, but what are you going to do, right? That's the nature of what we're doing. So. Okay, so it's not 100,000, right? The cost, what's recorded for cost of land is, or the commissions, attorney fees, if you're salvaging anything. So it's about $15,000 more. Okay, that's your answer. All right, that's your answer. So again, keeping yourselves organized. That's economics, accounting, finance, okay, all that stuff. You got to keep yourselves organized. Buildings or facilities where the operations, such as storefronts, offices, factories, warehouses, or airplane hangars are operated or used. Equipment, checkout counters, furniture, airplanes, aircraft, right? Vehicles consist of the cash purchase price, sales taxes, freight charges, and insurance during transit paid by the purchaser. We had an accounts receivable chapter where we sort of worked on some of that material. Okay. And we worked on some of that material, shipping and who pays the shipping fees and the insurance and all that. But that's another chapter. So for Merton, you're paying 50,000 property. Right. There's a sales tax in there. There's insurance during shipping, 500, and installation and testing. And there's your from row 82 to row 79. So those 4 rows, okay, will give you 54,500. Okay. And again, you just add those. Now, your journal entry, what you're doing is you're converting equipment from very liquid cash to less liquid. To less liquid equipment is what you're doing. That's what you're doing here. Okay. That's what you're doing. That's that journal entry date. Journal entries are based on date, right? So that's what that looks like. Your cash is less liquid. You're crediting an cash asset and then debiting equipment for the purchase of equipment for cash. This is a delivery truck, and there's a couple things happening here. You bought and I mentioned this in class as we're all driving around 1 and 9 and all those kinds of things. There's lots of trucks around, and I don't think there's anything that you can buy for 22,000 any longer. Again, maybe in 1988, but not now. So sales taxes are 1,320, and a one-time expense of painting the truck. The guy who works, I mentioned him a couple times, a Honduran guy who works on my house. He likes a black truck with yellow lettering. That's generally so. If he gets a van, I've known him such a long time, he's had various work vehicles. He had a pickup truck with yellow lettering, and then a black truck with yellow lettering, and 5-star contractors or whatever it might be, that kind of a thing. So all of those costs are, and he told me he looked for a new truck when he was buying it. It was close to 100,000, 80,000, 90,000, something like that. So, but yeah. So now there's a couple of things going on here. So we threw this all together: the delivery truck, sales taxes. We threw that all together, but there's more. So the equipment cost, what you're going to recognize as equipment, is 23,820. Okay, but there's some other stuff. There's prepaid insurance, 1,600. There's that 80 for the license. There's a license expense. Okay. And so then what you do here is an equal sum parenthesis, and you designate that array is what you do. Okay. And there's that. Added up those three: prepaid insurance, license expense. Okay. A delivery truck and related expenditures. Here's our last one. That also includes a journal entry. You're buying it again. These prices are outrageous. You're buying a truck for 15,000, which doesn't exist anymore. There's a sales tax 900, delivery cost 500, and you're painting the thing 200. And then what's left here: prepaid insurance 600, and a license expense of 80. These all get summed. Those 4 rows or those 4 lines. That's your 16,600. So the other 600 comes from here. And let's just check that. I'm just doing a little housekeeping. We don't need this. I don't know what possessed me to put those extra zeros in here, which we don't need. Yeah, 16,600. So this will be equal to the 16,600. And then the cash conversion is that. Okay. But there you go. Okay. That's what you're looking at with that. So it's the equipment, the insurance, the expense. So you're including a variety of costs with them. So it's a good way to sort of get started with this. I don't know if we'll do all the depreciation exam. We'll see. We'll see how we do. But depreciation is the process of allocating to expense the cost of a plant asset over a number of years. This is taught, and when I worked at Value Line, the guy made it so overly complicated that it didn't need to be. I almost didn't even know what he was talking about. But this is cost capitalization. So in other words, you're leveling out all the costs over a number of years instead of just absorbing a big cost in 1 year. That's basically what's happened. It's so cost allocation company to properly match expense with revenues in accordance with the expense recognition principle, the rules of accounting, basically. So depreciation is a process of cost allocation. It is not asset valuation. I did asset valuation last weekend. Took a long time to work on that. Okay, book value. We always care about book value. Cost less accumulated depreciation of a plant asset in this situation. It may be quite different from fair value. In class, I wanted to fix this. Okay. So fair value is in the market what you can basically get. Here, I separate out fair value and market value from the following. Market value is whatever you could get. Fair value is, and when an accountant sits down or a finance guy sits down, does a bunch of cash flow, does cash flow analysis, uses time value of money, and says, okay, what are these cash flows worth today at some sort of discount rate? That's fair value. If you're going to get what you're going to get out of something, and the other guy doesn't know any better, oh well, that's market value. I sort of look at it like that. When an asset's fully depreciated, it can have a zero book value, but still have a significant fair value. Yeah. Okay, we like that. Okay, we like that one. Depreciation applies to three classes of plant assets: land improvements, buildings, and equipment. And each of these asset classes is considered to be a depreciable asset. The usefulness of the company and revenue producing ability of each asset will decline over the asset's useful life. So again, what we're hopefully doing with the bishop out there in Greece is the following. Okay. Give him some sort of revenue producing ability as opposed to just an empty piece of land. We're going to put something on it and it's going to produce some revenue. That's what we're doing. So as basic as we could make it. Does not apply to land. Its usefulness and revenue producing ability remain intact over time. So yeah, land's not a depreciable asset. The usefulness of land is greater over time because of scarcity of good land sites, which is true. During depreciable asset useful life, the revenue producing ability declines due to wear and tear. Obsolescence can reduce revenue producing ability. Becoming out of date before the physical asset actually wears out, that can happen. And actually, all of these should be opened up a bit. The balance of accumulated depreciation represents the total amount of assets cost that a company is charged as to expenses. So yeah, so what's happened is you've recognized all the depreciation expenses and added them up. That's your accumulated up to that point. It's like a retained earning almost. A going concern assumption states that the company will continue its operations for the foreseeable future. If it doesn't use going concern assumption, then the planned asset should be stated at the fair value. In that case, depreciation is not needed. So, yeah, okay. But I've used going concern in contracts, and I'm looking forward to having more time to spend on the contractual part of what we do. Costs are all expenditures necessary to acquire the asset and make it ready for the intended use. Useful service life or productive service life, estimates of the expected life based on need for repair, service life, and vulnerability due to obsolescence based on. Salvage value, estimated the asset's value at the end of the useful life. And depreciation is reported on the income statement. Is also accumulated report on the balance sheet. So that's where those sort of show up. And here's sort of the three rock stars here: straight line, units of activity, and declining balance. Those are the three methods that we're going to be looking at. All right. I'm just getting rid of that extra. All the extra zeros that are sort of lingering here. Each method is acceptable and generally accepted accounting principles. Selects method it believes to be appropriate. The objective selects method that best measures the asset's contribution revenue over useful life. Once a company chooses a method, it should apply consistently over the useful life of the asset. Consistency enhances comparability of financial statements. Depreciation affects the balance sheet through accumulated depreciation income statement through depreciation expense. Yeah. So there's accumulated. Okay, so we have this delivery truck. It's going to cost, the initial cost is 13,000. Salvage is 1,000. Again, these numbers are 1988 numbers. It's got 5 years of useful life and 100,000. The straight line method is expense the same amount of depreciation for each year of the asset's useful life. So yes, what you're depreciating is you're not depreciating 13,000. You're depreciating 13,000 minus 1,000, which is over 5 years, which is 12,000 over 5, which I think was about 2,400. So the depreciable cost when we compute it is 13 minus 1,000. The expense is that 12,000 over the 5 years. And the rate is the 2,400 over 12,000. Right. And we have these little red triangles that give us little helpful hints: cost minus expected salvage value, things of that nature. Okay. When you straight line, it applies as a percentage to the depreciable cost of the asset, and we're going to illustrate that right now. So, just open these up a bit. The first year, I think, is 2012. This is in the textbook. Just look up the textbook. This is the first year. Italics, make it smaller, center it. Control 1, number. when you have these little indices, you don't you don't need to make them gigantic. You don't need a big you don't need indices to pop. You want to focus on your numbers here. All right. So your depreciable cost is at 12,000. Cost is at 12,000, and that doesn't change. You're just going to set it everything equal to the cell above it. Okay, the rate is at 20%. Okay. But again, this is straight line. It's going to be very clean, version of everything here. So the expense is going to be the product of the 12,000 times the 20%. So it'll be 2,400 every year. You're just taking 20% times 12,000, and you're just doing that every year. Okay, and bring the formula down and make sure you're formatted the appropriate way. We could do depreciation a couple different ways. With this one, let me do sort of the little more complicated version of this. We're going to latch on to the row and latch onto those columns. All right. So what we'll do is we'll say copy. We'll do actually we can do them all Alt-H formula. What we did was, you can see every year we just keep accumulating until depreciation until we got to 12,000, which is the number that we're after. That's the yellow one. Okay. So those are the last ones. They're all added. So if you don't anchor that row, your starting point will just keep getting lower and lower. You'll start missing some of the original ones, and this just keeps you in the column that you're working in, the U column. Okay. So obviously you're depreciating 12,000. Your book is that cost, and that you're an anchor minus the accumulated depreciation with the column anchored. Okay, so the book just keeps again. It gets down until you get to that yellow right there. Okay, and what do we say here? This is the salvage value. That's the $1,000 salvage value, is what that is. Okay, keep your commas in decimal places. The percent depreciated is just simply this divided by the depreciable cost. And you can go, obviously the last one's going to be 100. All right. Okay. That's straight line. The book value, again, you're just referencing up here. You're referencing that 13,000. And you're just going to keep subtracting depreciation until you get to your salvage value. That's book. That's the most important concept that I wanted to discuss. And in terms of a problem, yeah, these up the partial year versions of everything. The PowerPoints had something like this, and actually, let's see if we can find it. Yeah, here you're assuming you only had 9 months of that first year. And I sat there and I said, well, let me actually, you know what? Just looking at the time and everything here, that might be a good thing to, because what I could do is we could start the other depreciation methods in other videos, but let me reproduce this for you guys. Okay, let's see how it's different. Yeah, so how it's different is you're going to spill over into other years. So, you know what? Let's do this. Let's see how far we get when we do this. Yeah, these are always tough to. But it's good you see this a little bit, though, too. So you sort of struggle with it. It's there. It's 10 of something. You're going to have to find that one where there's 10 of them. Probably this one. Yeah. All right. All right. So we made some space up here. I don't like to do these things sort of out of hand like this. But so obviously this is going to go to 17. So let's do this. Let's say copy, paste. Don't need that. And there's your numbers. You're colliding with this, which is bad. I'm going to cut these. I'm going to drop them there. I'm going to make a left border. And it looks like, yeah, because we're going to do partials of the years, right? Yeah, this is the prorated version. This is April 1st instead of January 1st. Folks, that matters. That matters, right? That stuff matters. You have 9 months in the first year. Okay. So what you would do is, and yeah, you're going to have an extra year, of course, also with this. So your depreciable cost would be the 12,000. That would still be the 12,000. Now your rate, what's the rate going to be? Okay, the rate's still the same the whole way. Okay, the rate is still the same the whole way. Yeah, it looks like we knocked out. Yeah, we need more. I needed more real estate for what I'm trying to do here, but okay. The rate is going to be the same. The rate's going to be the same. And then what you do, well, these we don't need, I suppose. Just for sort of lack of space. You still have annual depreciation, and then you have partial year. Bold. So in terms of percentages, yeah, current year expense, we sort of jammed it in there a bit. So this is going to be equal parenthesis. So you're not showing that 9/12 initially, right? Because what's happening here, this was acquired April 1st, 3 months into year with 9 months remaining. Something like that. And let's see, closed out 3 months into 2017 to balance 9 months. That's what it's for. You're balancing the 9 months into 2012. Okay. These are all 100%. And this will be 3 months. So, yeah, see that? How that works? Like that. And that it's actually V. There's your 12,000 again. And here's your, yeah, there's your 13,000, the cost. Okay. So this, I said I would do it in class. I said I would work on this. So this is the partial version of things. Okay. That's what the partial looks like. So this is your normal. That's your normal computation. Current years with a partial. So you have 4 full years, 9 months here, and then 3 months here. This is 9 months. And this is 3 months. We got that right word, prorated? Yeah, prorate. Okay. And with the percentage, you can sort of jam it in there. Again, folks, I apologize for having this sort of cramp. I want to put the numbers in, but we know it's 6 years. Okay, we know it's 6 years. Okay, that's the percentages in there. Again, we percent depreciated. We would do this in a nicer. I'm just trying to jam this in a very sort of in a very charitable way right now. Okay. Like that. Okay. So you have all that. And the percentages are going to be a little bit different, right? It's going to be accumulated, still divided by the depreciable, but the accumulated is going to be different because of the prorated years. You have these partial years in here. Okay, but that's how you do straight line. Okay, that's how you do straight line. So we had a couple journal entries. Okay, and actually, let's see. In terms of time, folks, let me say it's a big effort to sit here and do all this. Let's see what's next here. Um, yeah, there's another prorated version of this thing. It's good, like I said, folks. It's good that you see, big pieces of real estate sort of moved around like this. Yeah, there's a lot of other stuff here. What else is here? Patterns, the whole thing. Okay, that was straight line. Units of activity, I think we can fit this into. Straight line is 8 out of 10 of them that you'll see. Match sequence with revenues, and it's reasonably uniform throughout, and that's kind of it. Once you start trying to capitalize other costs, which is a problem, yeah, I don't think you can capitalize operating costs or those kinds of things. It only works for plant assets, but some companies try to do it all, and then they get into trouble. So units of activity, instead of just an even sort of rampage of expenses like we just worked on, it takes the depreciation based on how much you use the piece of equipment. Okay, so this is the same Yeah, this is that same 12,000 again. We'll find it. How many times you have to do this? It's 13,000 minus 1,000. That shouldn't be too complicated. Total units of activity we had up here in mileage, 100,000 miles. So what this means is you're going to do 12,000 over 100,000 miles. Okay. And then for the first year, it's going to be, what is it going to be? Yeah, let's do this. Right there. Okay. So obviously the first year of this is going to be now this again. I use this example in class for those of us who were driving into that wonderful campus in Jersey City. Those PSE&G trucks, they've got vehicles that move from vans to big bucket trucks that probably cost $100,000 or more. The vans probably cost 60, 70,000 or more. It's just a medium sized work vehicle. So those things, the last thing PSE&G wants to do is tow them and this and that, and it's got 250,000 miles. So there might be some sort of cutoff that the accountants and the management people decided, hey, we're not going to drive these things because the expense of work. See, with my car, my mom is up there and she can get in the car that we have, so it's low, so she can sort of slide in easy. I couldn't drive a Hummer or something where there was a big step up, to get into the vehicle. So I'm going to keep it and just keep fixing it, and as long as I need to. But yeah, law enforcement vehicles, cities, they like to get rid of their trucks and pickup trucks and water department trucks and law enforcement SUVs and fire trucks. East Orange, when I drive in the morning, I see they have some what are they called? Is it a bucket tower ladders? Where it's not the fire, like in Los Angeles. If you look at a fire truck, like a hook and ladder in Los Angeles, the fireman's up there sort of latched onto the ladder, holding on and spraying this water on the fire. And he's hanging onto the ladder. He's just at the top of the ladder, and some of them can go way up there. A tower ladder, and the FDNY has them, and now New Jersey has them too. Like I saw East Orange with them, and I saw them training on one little side streets a couple summers ago. It's a tower ladder is a platform that you stand on, and there's a little gate, and it's probably a lot more comfortable to work on. And there's lights on it, like fire engine lights, and white lights, like sort of white search lights are on it. And obviously there's a nozzle to spray, but it's a much more comfortable platform to fight a fire from. So but those things, that's an expensive piece. That's probably a couple 100,000, easily a couple 100,000 piece of equipment. And how many now? It's in an extreme environment of heat. And believe me, if a building's on fire and you're parked outside of it, the truck's going to warm up, and it's going to wear a little more than just a normal car just driving through the streets of Essex County or Hudson County. If you're constantly driving to fires and you're sucking in air into the engine, and there's ashes and there's a lot of debris in the air, you're driving these vehicles very hard. So it's going to have a shortened life just because of the extreme nature of the use that you're putting the vehicle under. So the East Orange or whoever can say 100,000, that's it, right? So in other words, the depreciation expense here is the product of that 12 cents per mile, and the other part of the array is that 15,000. So for your first year, right, your expense is 1,800. So that's the units of activity version of this. So what we'll do here, we're going to say equals product. Actually, this is the per unit number. We're just going to equate this to the 1,200, or the 12 cents a mile. And the expense is at 15 and the 12 cents, which is there. What do you have here is you got the 12 cents a mile times all the miles that you drove it. Now, 30,000 is pretty mild, I think. You know, especially if it's a law enforcement, you're driving around, especially for state police or something, right? The Massachusetts State Police or whatever it might be. Okay. So now you have a different version of expenses. Again, with accumulated, we can use that same formula, or we can do this. We can say equals 1,800, then equals the previous total plus the annual expense, and then just drag it all down. See what we're doing? So what you're doing is you're taking the previous total and just add the next year's expense. That's how you get your 12,000. Because that's what you're trying to depreciate. Okay. Now, so you want your book to be 1,000 is next, right? You want your so again, what you'll do is you'll say equals. You'll look for that 13,000 somewhere wherever you find it. You'll lock onto those. Subtract the accumulated. Until you get to 1,000. Right there. That's how you get to 1,000. Your salvage is that. Okay. And you can apply this for mid-year purchases. We just saw a prorated version up here, right? We did the prorated version of this thing, and prorated. There's a declining balance version of this also. Yeah, so there's another prorated version of this here. So prorate the first year. Okay, so we're not going to make that graph today. So for declining balance, it's going to be equal to 2 times that initial 20% that we computed up here. There's your 20% from the straight line method. $40. The book is 13,000, right? We should just type it in. Yeah, this version, you might need a little, you might need some decimals on some of these. I'm just doing a little more cleaning up, if you guys don't mind. Okay. Yeah, we just cleaned up some of our numbers here that needed cleaning up. So yeah, we're gonna go back. We're not gonna make the graph today or anything like that. Because what we'll do is, I think, which is comparison. That's probably a good place to stop. So this 247 and equals product 40% times 13,000. Okay. So this rate will be 40% the whole way. And let's pick off these the 5 years here. That's that. And this is going to be equal to that's your 13,000. That's going to change. Yeah, that's going to change a bunch of times. Okay, so your annual depreciation expense equals the product of the 40% times the 13,000. The accumulated is just that expense The book is cost minus accumulated depreciation. So actually, you know what? Here, let's do it like this. And the percent of this thing depreciated is this divided by, no, it's just divided by, you got to find that, yeah, you got to find the 12. And actually, while we're looking at that, let me check Change activity, declining balance. Did this come out? Yeah, it came out to 100%. Yeah, okay. No, that's fine. All right. So the new book is what you ended the year with. So it's a lot. 8,320 is a lot. And the new book is the previous minus the annual depreciation, 4680. All right, like that. The previous book, and then you subtract out the next. Yeah, and you're 70% through all of this, right? Because you've depreciated about 8,000 of something that you appreciate 12,000 depreciable cost. Okay, this is 46. This is another annual. This is 1,872. What is this? That's the previous accumulated plus the next one, the next year, right? That's 10,192. The book goes down to 2,808, and this is 84 to 1,000. This is just this. This is just the 2,808 from the previous year. Again, accumulated, you're up to 11, 315. Book is down to 1,685. And you're down to 94. And this is the starting book value of the next year is the ending one book value of the previous year. So that's some good balance sheet math for you. So you should want to take out 685. That's what you should want to. So you should want to take out, but it's not. It's not going to be 685 because if you do the math on this, it's 674, not 685. So this depreciates to 11,090, about $11 short, and about 0.1% short. So what you do, or what we did, is we took this. We said equal sum. That's your 12,000, right? Up to 11,000 for 15 and 685. The book is going to be that's the 1,000 that you're looking for. There's your 100%. Okay. Again, so some of the math sometimes doesn't work out as magically as we'd like it to work out. And the last bit of this, we did a check for some, I don't know why we did a check. We did a check of 13,000 minus 1,000 minus that 11. Okay. So we did here. We took 13,000 minus 1,000. It's up there somewhere, but I just typed it in. And then minus the depreciation to the next of the last year. And that gave us what that 685 that we're looking for. So sometimes you have to work with these a little bit. Yeah, there's another prorated version of this. I think that, and that'll be it for today. We're still here, which is good. Okay. Okay. So we've also had this in the PowerPoint someplace. This was declining balance. Yeah, we're going to prorate now with this one. Again, this is the partial year version of this. So we're going to go up to 17. Okay, and we'll get to everything with this. So what we did, we sort of collapsed that a bit, and we took this and cut it across. All right, prorated there, prorated there, and this is again April 1st. So your rate is still 40%. Your rate is still 40%. Your beginning book value is 13,000. And your expenses are all these numbers. All right, let's not worry about everything just yet. Let's get the first things first. And then you did your 9/12, which is that. And the accumulated is not this. Okay. That's 9 months. And the book is 9,100. Okay. Now you don't have books. The PowerPoints don't give you the book, but accumulates 39, and the next one is 36 284. Yeah, so this one goes into the 3 months of the next year of 2017. All right. So what are we doing here? Purchase the truck, depreciate for 2012. Yeah, 3,900. That first one's 3,900. Okay. Is 91. And the 13 depreciation is 346. Okay. Looks like we're on a good track with this. Because now you just take the previous book, right, and just keep going coming down with it. So accumulated 75. 97, 11, 1182. Now you want this to be, so here's where you got to do your thinking now. That's where you got to do some thinking here. Beginning book is this. Up to here, we're good. We're good to there. All right. Yeah. So this doesn't help you here, right? Because look where it gets you. You didn't accumulate the entire. Um, you didn't accumulate the entire 12,000. You did not do that. Okay. So this works like what we just did. Okay. This is the prorated declining balance method. It works the same way. All right. So these are all just products, and then we take the ratio based on the year, on prorating the year. See? But for the first year, it's 9/12ths, and the last year it should be 118, but we're going to put a plug in there, and we'll bounce down. We'll bounce down to the next line to do it. Because now the percent depreciated is only 99 and a half. Okay, you want the accumulated, yeah. You want the accumulated to be 12. So you're off by 61, right? 61. So equals 118 plus. Yeah, there's your 179. Okay. And what is this really? This is this plus parenthesis. All right, there's your 179. That's what you want. See, it took what's above. and this just come. This is the blue one. So it's 295. Yeah, there's your 12,000. Is the book 91? Yeah, the book is 91 because of this. Yeah. And the next book, depreciate, 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 depreciate. It's those two. Are you down to you're down to 708 again with this, right? There's your 1,000. Okay. The book is 1,179. You take out the 179, you get your 1,000. Okay. So here, this one took a little thinking. Let's just review. So you start with 13,000 starting book value. You're going to depreciate it 40%. That original product gives you for a full year it's 5,200, but it's a partial year, so you're only taking 75% of it. So the accumulated depreciation is 3,900, and the book is 13 minus that 39. So you've depreciated 32%. The new book is 91, another 40%. Now that's a full year. 3,000 comes off. The previous accumulated plus 3,640. The book is the previous book minus the new depreciation, 62%. Third year depreciation, 5,460. Again, 40%. And this is the same 2,184. Again, accumulate that to 9724. The book is 5,460 and another 2,000 subtracted out. You're to 81%. Fourth year, the book is 3,276, 1,310 depreciation. Add that to 9724. The new book is about 2,000. You're down to 92%. The fifth year, 1,966. So that should be 786 annual depreciation for the full year. Add that to the 11,034, 786. And that comes off the book, 1,179. You're down to 98.5%. Now, the partial last year, the book is 1,179. So you should be taking off 472. 472 is partial, okay, which only gives you 118, but you need 179, right? You want to get to 1,000 here. Okay, you want to get to 1,000 right there. That's 118. This should be 12,000 and it's not, okay? Because you use the 118 and it leaves you whatever that is, $61 short. Plus the 118 gives you 179. Right? That's what we're doing here, right? So 179 is what really needs to. These other two numbers don't mean anything. So you pull out 179 as the expense. So your cumulative depreciation is about 11,821 from the 5th year, and then the 3 months of the 6th year is 179. 1,000 comes out of that, 179 also, and that's your 100%. Okay, and that's it. Let's bring the rest of this stuff up so I don't lose it or forget about it. There's another problem in here. There's a graph. We're going to revise this. So yeah, this will be good for the next video. Save. And that's it. And we'll pick up next time here. So the next one's going to be, this is sort of a repeat of, we'll review straight line for a little bit longer version with a journal entry. We'll compare. We'll make this graph. I'll fully make the graph. We'll see. Maybe tomorrow morning we can do it. We'll see. And then we have some revisions here. So yeah, that's enough for another video. It'll be a short video, but that's enough for another video. Okay. Again, folks, I didn't do the picture thing tonight, so yeah. So again, as I promised in class, we did the revisions. All right, we did the revisions like I promised you guys in class, and we'll see you next time. Thank you.